All right, guys, let me know if you can see and hear me here. All right, we are live. Sorry about this. Obviously, I don't do a lot of live streams here, so whatever I started last time, it wasn't letting me actually go live. All righty. All right, so we are talking about inflation. Let's give just a couple of minutes to let everybody from the other stream join in. All righty here. We are going to be talking about the record-breaking inflation today. We are seeing another new record in inflation, fresh 40-year high. It's up to 8.6% year over year. I appreciate you choosing me over Lynn Alden, although I'm not sure that's the smartest move there. I would probably choose Lynn Alden over me. Yeah, inflation is burning hot everywhere right now, all around the world. We are seeing at the same time asset prices collapsing. We are seeing inflation in food, in cars, in rent, in housing prices, in energy, pretty much everything that people have to buy to survive. Those prices are going up. And then everything that people usually buy to make money on, like stocks, those things are going down. So we are in a period of time that is not fun for most people right now, unless you're one of them ivory tower elites isolated from the realities of everyday life, like the Federal Reserve and the federal government. All right, I'm going to see if I can pull some screen sharing up here. We're going to look at a few charts. All right, I'm trying to pull up this article here. Give me 1 second. We're going to look at some charts, some numbers. All right. All right, it's actually, I guess I didn't have screen sharing ability for my browser, so it's going to make me end the browser, so I'm not going to end the live stream just to share that. So we're going to go through the numbers here. So inflation is at a 40-year high right now. That means year over year inflation. So May from 2021 through May of 2022. This year, we have not seen inflation this high in 40 years. And that is the current way that inflation is measured. We know that inflation in the 80s, the early 80s, they started changing how they measured inflation. And so when we take a look at what the inflation numbers were throughout the late 70s, when they were getting really high, very crazy, when Volcker was trying to fight inflation by raising rates, That was a time when inflation was measured differently than it is today. They started introducing things like hedonic adjustments. So when people would change what they bought, they would factor that into the inflation numbers. So let's say if steak gets too expensive, people start buying chicken, then they're going to more heavily weight the chicken instead. But that's not actually measuring inflation anymore, measuring the true cost increases. That's just measuring the cost of survival, basically. The other thing about that is that when prices get too high, people are going to switch, which means that the prices of those things are going to stop rising from habits changing. And so even if you keep measuring the thing that was going up, let's say you keep measuring steak as it gets higher and higher, well, eventually that price rise is going to stop because people have to change their habits. And so inflation just in itself is a very difficult thing to measure. So they started introducing things like that, things like quality adjustment. So we can look at the Bureau of Labor Statistics has a table of all of the items that they change how they measure the price, how much they include those price changes into the inflation, the CPI, given quality changes. And so things like pants, literally, they if pants go up in price, they're not going to, in the CPI, capture that whole entire price increase because they say, well, the quality of those pants increased because maybe they're made out of different materials. And I don't know about you, but I don't think pants are lasting longer than they used to. I don't think people are getting that much more out of their pants than they used to. It's just an item of clothing. But in any case, they factor things like that into the CPI. So if inflation is measured today the way that it used to be, then it's probably, it could be at an all-time high. It's unclear exactly where inflation is, but it's at least higher than it is right now. Now, the March inflation numbers were high. Then April inflation came down. And so a lot of people are saying inflation had peaked. And now 8.6, it jumped right back above where that March number came in at. Why change the CPI? Well, one reason is to communicate to the public that you have control and that you have gotten, a handle on controlling inflation. And so it's really interesting that in the late 70s, early 80s, right when inflation peaked and started to come back down, that was the same time when they stopped, when they started changing how they measured inflation. And so that is one reason. Another reason is because there is an element of validity to it, right? Because you look at the average cell phone today and you have to buy, you buy one smartphone for $1,000 and that has the same amount of stuff in it that you used to have to buy all sorts of different things for, a camcorder, a camera, a calculator, maps, atlases, or navigation devices, those TomToms and those GPS map things. So all these things that people used to have to buy separately, the cost of them aggregated together has come down into one device that's still relatively expensive for a lot of people, but not compared to how much they're getting. And so there is an element of validity to trying to adjust how you're measuring prices over time, because if you just measure them in a stale way, it's like if we still measured inflation like they might have wanted to do like 100 years ago, well, then we'd be measuring the cost of stirrups and whips and, buggies and horses and things like that people don't buy. And so you do have to update it. But when there's a conflict of interest involved, trying to communicate, hey, we've got a handle on inflation, then you kind of have to wonder how valid the adjustments that they are making are. Yes, this is really live, Bass 3Do. Let's see here. Okay. All right. So the thing to watch here is month over month inflation. That's the thing that I'm paying most attention to right now. Year over year inflation, obviously 8.6%. And that's an average number. So when we look at all items together that are measured in the basket, we've got 8.6%. When we look at food, year over year inflation in May for food, it was 10.1%. And so that is higher, obviously higher increase than the average of everything they're measuring in the basket. But the real jump came from energy. Energy up 34.6%. It's important to remember it's not because of Russia invading Ukraine that energy is getting more expensive. It's because of the response to Russia invading Ukraine that energy is getting more expensive. It's the choices by everybody that are trying to inflict pain. They have to inflict pain on themselves as well, or really their constituents. So sovereign countries, nations, individuals who have the power to make these decisions are saying, hey, we want to try and punish Russia, but in order to do so, it's actually going to punish us as well. And so that's where a lot of the energy price increases are coming from, not from the invasion, but the response to it. And so I'm not making a value claim on that, whether that's good or whether that's bad. I'm just saying that's the way it is, and you can make up your own decision about whether the response has been a good response or a bad response. If we remove food and energy, we got an average of 6% increase in prices across the board. And so 6% is still very high. And Biden talked about this today. Let me pull up exactly what he said. He says, today's report underscores why I've made fighting inflation my top economic priority. And I apologize for those of you who are just joining. The reason why I don't have this up on the screen is because I don't live stream that often, as you might be able to tell. And I didn't grant my browser access to share screen beforehand, and it would make me restart and the stream would end. So I'm not going to do that here. I'll do that next time. So he said, today's report underscores why I made fighting inflation my top priority. While it's good to see critical core inflation moderating, it is not coming down as sharply and as quickly as we would like to see. Now, 6%, I don't know why that looks to him like it is moderating, but even when stripping out the things that have gotten most expensive for most people, food and energy, which are the things that people have to keep on buying with the least elastic demand, you still have 6%. That's still much too high. All right, so in response to this inflation, we've seen a big drop in stocks. So the stock market, the S&P 500 is down 2% right now. The NASDAQ is down 3% right now. The Dow is down just under 2% right now, and the Russell 2000 is down a little over 2% right now. So tech stocks are taking the biggest hit right now. And this is basically because, hey, with inflation numbers not showing a peak now, they didn't move down from what the April year-over-year numbers showed. That means that the Fed's going to have to get a little bit more aggressive potentially in fighting this. They're going to have to at least stay the course that they promised, which means that they're going to be hiking rates still. And in fact, Barclays traders are now pricing in the higher likelihood of a 75 basis point increase in interest rates. They see a 50-50 odds, 50% chance that the Fed will raise rates by 75 basis points. That's 0.75%. Now, 0.5% was the most that the Fed has raised rates by in like 2 decades. And so this would be, I'm not sure if they've ever raised rates that high. We'll see what they do. I would imagine that they, just given how slow they are to respond to things, I would imagine that they'll continue on their current pace. All right, GameBiter, thank you so much for the gift there. They're saying high retail inventory will cause deflation, but won't that be temporary and make food necessities more expensive? So it depends on what. So we're experiencing this really weird time right now where basically we're seeing a transition from the boom to the bust. So this is getting into a little bit of Austrian business cycle theory, where the boom is not a result of just the natural business cycle. It's a credit cycle. It's a debt cycle. It's a cycle built on the expansion and contraction of the monetary supply, given monetary policy, how easy it is to get debt. And so when the money supply expands rapidly, as a result of too low interest rates and easy money policies, you get a boom because everybody starts getting more money. Now, it doesn't make its way evenly to everybody, so it makes its way to some players first, like corporations who have government contracts and politicians and people like that. So it enters the economy through certain avenues. They get to spend this money at the original prices. And then as that money works its way throughout the economy, when I spend money, that's my expense, that's your income, goes into your bank account, then you go and spend that on something else, and it works its way throughout the economy like that. you're bidding up the prices of everything throughout the economy. So you have this initial boom that usually hits asset prices first, and then it bleeds over into goods and services, and then it bleeds over into wages. That's the Cantillon effect. And so we see this boom is now transitioning into a bust. And we saw that start at the beginning of this year in assets. That's why at the beginning of this year, we peaked in stocks, the S&P 500, the NASDAQ, the Dow, the Russell 2000. That was those were the highs for the stock market there. But meanwhile, so asset prices have started to fall. You still have the prices of goods and services going because there's a lag time there between when the prices adjust from assets to goods and services. So we're seeing right now kind of the worst of both worlds, whereas at the beginning, everybody was really happy and euphoric, and it was great because assets were going up, but prices were adjusting. There was no inflation in the beginning, and so in goods and services. And so everybody was happy because there was the boom. So now we're transitioning to that bust. And the thing about the bust is that it's inevitable because of the boom, because the boom was a false boom built on the expansion of the money supply from easy credit. And so a lot of people get this wrong about inflation because they're saying that you need the interest rate to reach above neutral in order to combat inflation. That's not true, because the forces that are pushing everything up are artificial forces by themselves. So just pulling back on those forces a little bit that are pushing things up, it's like eventually a rocket's going to run out of gas and it's going to fall back down to earth. Unless you provide so much fuel that it escapes velocity, that's hyperinflation, a collapse of a currency. But outside of that, everything tends to start to fall. And so you have during that time when the boom is happening, you have malinvestment take place. And so this is where I'm getting to your question, Game Biter, about the retail inventory. You had such high spike of demand that it took a while for companies to adjust to that and start to try and build up their inventory to meet all of that demand. There were a lot of shortages for a while in regular stuff. And so by the time that inventory has piled up, now demand is starting to fall off because prices have gone up. People don't have the extra income that they thought they did. So demand is starting to fall off a cliff, especially for like luxury items, things that people don't need. And so now the inventory is piling up, and now you're going to have that bust that's inevitable based on the boom that was a false boom that caused all that malinvestment, that inventory buildup that shouldn't have happened. But that doesn't necessarily happen in everything, because there are some things with inelastic demand like food and mostly energy, things like that, that people, no matter what they cost, will just cut out all the other expenses to make sure that you can still feed your family. And so we're going to see big, Target, that's been making the news lately a lot, that they said, hey, we got way too much stuff. We're going to have to, put stuff on sale a lot. And so same sort of things happening there. But necessities, people are always going to have to buy there. All right, let's see here. Okay, so how can they say the consumer is strong when you look at consumer confidence, personal savings, and credit card debt? Yeah, I don't know who is still saying that the consumer is strong here. The consumer is absolutely not strong. I've pointed out in a couple of videos recently what you just pointed out there about the savings rate, the personal savings rate, which is divided by it's calculated by using disposable income, and that has just absolutely fallen off of a cliff. It is below where it's been in years, and that's because people are spending all their money on surviving right now. The other thing is debt. Again, I made videos about this recently. Debt for the government, debt for corporations, debt for individuals, all-time highs, and that's both housing debt and every other form of debt. And so that is, people are loaded up with debt. People have no savings. Prices are still going up. The consumer's not strong, and consumer confidence is at one of an all-time low right now here. So Yellen, Yellen, that doesn't surprise me. Yellen saying consumers are strong, but a lot of that might be coming from just the demand for necessities. So people are looking at, hey, well, everybody's still buying this stuff, and so the consumer must be strong, not recognizing, hey, well, they're going to buy it no matter what, even if the consumer's not strong. It's not like people in Venezuela just stopped buying food. I mean, they stopped buying as much food. That's why I think in 2017, the average weight loss in Venezuela was like 17 pounds in 2017, something like that. Crazy, because there's just, people couldn't get enough of what they needed. But to the extent that they could afford it, they were still buying their necessities. That wasn't the consumer is strong. That's just people do whatever they can to survive and provide for those around them that they're responsible for. When do I think we'll begin to see a big player break due to the rate hikes? I think it'll take longer than we would expect. The biggest reason for that is the reverse repo market. There is $2 trillion right now in cash that is inside the reverse repo market that at any point when rates get too high, the Federal Reserve can lower the rate that they're paying in the reverse repo facility, and then all that money will flood out to get the rate that it needs. Right now, they're getting that risk-free basically from the Fed, so they don't want to deal with the volatility and the risk in markets. And so, as soon as they bring that reverse repo rate down below the Fed funds rate, a lot of that money will come flooding out, and it'll have to go into short-term government debt, and that will be like $2 trillion of stimulus for the financial system. It won't impact everyday individuals, won't impact the stock market, but it will keep the system kind of going. It will keep rates suppressed on the short end of the curve, even while the Federal Reserve raises the Fed funds rate. And so it'll take longer, I believe, unless something more unexpected happens. If Taiwan gets the Hong Kong treatment, something like that. If there's an escalation of war in Europe, if there's some more unexpected things that happen somewhere, then absolutely that could tip over into a major financial crisis where we start to see institutions getting knocked over like dominoes. But apart from that, just the way things are going, I would anticipate sometime closer to the end of this year, not as soon as the next couple of months. All right. So the traders are now anticipating a higher interest rate hike, and that is impacting stocks. Everything is selling off, but I want to highlight gold here. I know you guys are pretty much split. I read the comments pretty closely here on this channel, and you guys are pretty split on whether you like Bitcoin, whether you like gold, and whether you like something else. Neither one of those. But the reality is, if you were invested in gold and stocks throughout this year, 2022, you've increased your purchasing power in gold. In fact, compared to dollars as well, I think we're up on the year. Yeah, we're up on the year right now in gold. And so pretty much everything has fallen this year. Gold has been volatile, but it has moved largely sideways, a little bit up. And so when you look at inflation, you're like, oh, well, we're seeing inflation right now. Gold's not keeping up with inflation. That's true, but it's doing better than dollars, number one. Number two, we tend to see a delay in how price changes go through the economy. Like I mentioned earlier, asset prices, then goods and services. And so we saw the response that gold had to the future inflation happen when all the money printing happened in 2020. Gold went up huge, and then it started moving sideways from there as it started to price in deflation. And I think at least right now, we've got a very good chance. Like I mentioned earlier, all you have to do is pull back on some of those inflationary forces, and the bust is strong. It's like gravity. The deflationary forces build up over time. That's why throughout history, you've always seen long-term natural deflation happen. So when you have a financial system that is built on causing inflation to happen, that's going against nature. So eventually that breaks and things fall down. And so all you have to do is pull back on some of those inflationary policies, and you don't even have to get to neutral or above neutral where you start pushing things down. All you have to do is pull back, and the natural deflationary forces will take over, and you start to get a crash. And that's what we're seeing in asset prices right now. Asset prices have been tumbling, and gold has not. So you've increased your purchasing power there. And one of the biggest deflationary events in history, the Great Depression, gold increased in purchasing power as well. What will the Fed do next? Is there a melt up? I don't see a melt up happening right now. When the Federal Reserve reverses course and they start QE again, that's my buying signal. I think we've got a lot more pain in assets until that point. But the Federal Reserve they're backwards looking. So they're looking at this data as it comes in from behind. They analyze it through the lens of broken models. And so it takes a long time for this stuff to catch up with them. And by the time it does, they'll realize, oh, there's a crisis that we have to avert here by reversing course and supporting things again. They're not watching the stock market. They're not watching your brokerage account. They're not watching your 401k. They're not watching these things that many Americans wish they'd be watching. Their number one goal is to meet the mandates given to them by Congress, which is stable prices and full employment. And we can debate all day long about how effective they are at achieving those or what their under the cover goals are about those. But right now, they're still looking at old jobs data and saying, hey, we've got a strong economy because there are lots of job openings. They're drying up fast. And by the time they realize it, we're going to have mass layoffs everywhere. We're already starting to see layoffs happen. For every company that you see doing layoffs, there's another 10 that you don't hear about doing layoffs. And there's another 100 that are thinking, hey, in the next couple of months, we're going to have to start layoffs. This is anecdotal, but I've seen spending dry up like crazy. Pretty much everybody. So this is, one aspect of corporate spending. Pretty much everybody on YouTube, all the other content creators that I know that I talk to that have worked with sponsors or make any money from ad-based revenue at all like that, they're all saying it is drying up like crazy right now. Companies are just shutting off all of their marketing spending or most of it. Like I've literally seen marketing budgets go from 100% to 10% within a month and no plans of bringing that back. And things continue on this way that they're going. That's discretionary spending. It's like, okay, shut off marketing. But then if things get tight enough, they're going to stop hiring people. They're going to start laying off people. And so these things are turning really fast. And when it hits, then the Federal Reserve is going to have to make a choice between, hey, do we want to try and bring employment back up by making things easier again? Or do we want to keep on fighting inflation? Because it's possible we start to see the unemployment spike again while we still see year over year inflation going higher. So we'll see how long it takes, but that is definitely a big possibility. And thank you for the gift there. All right, Wild Blue Whippets, you said no layoffs here, but they're not filling positions where people are leaving the company. Absolutely. So that's the other thing you're seeing. For every 100 that are saying we might have to lay off soon, there's probably 1,000 that are saying, hey, we're just hiring freeze right now. We're holding off. And so that I'm seeing that happen everywhere as well. Goldfinger Trading, thank you for the gift. Speak on the 1 quadrillion futures market and what you know about Capital Group and extend to the global commodity exchanges if they stop swapping. If I understand the question correctly, yes, there's the derivatives market is like many times larger than what it sits on, the foundation that it sits on. It's like an upside down pyramid, if you want to have a visual representation of it that way. And absolutely, you can have major problems crop up because of this, because of how much leverage there is. So the reason why it gets so big, I use this example all the time, but they're many times looked at as risk-free trades here. An example of a risk-free trade would be kind of an arbitrage trade where you are looking at I'm going to short one thing and buy another thing, and one side of that trade is going to be a derivative. And a lot of this is done to hedge, but some of it is done to just make a small spread. And so you'll have something where you try and lock in a small profit opportunity between two trades, one short and one long, and there's a small difference, and then you're just going to wait until either those converge and close them out at your small profit, or you're going to close them out if you can. The problem with this is that these are highly leveraged, because you look at that and you say, okay, well, if this is a risk-free trade, I can borrow a lot of money and ramp up the frequency or the quantity of those trades to make a lot more money. Because if I can only make 1 cent at a time, well, I need to repeat that many times to make any meaningful money. And so you'll leverage up on that trade in order to make it worthwhile. And the problem with this is that when something unexpected happens, you your models are based on, anything historical that has ever happened before, well, anytime in history you've had something happen that's never happened before, that was not able to be included in those models. So that's why you get these blow-ups. And so it's just something unexpected happened because it had never happened before in history. But those kind of things that have never happened before happen all the time. And so then you have a blow up where instead of these two trades converging and being able to close out, they get wider and wider until the point where you get called and you have to close those trades out, which makes them worse. And if other people are involved in those same trades, then it can lead to a cascading, domino effect. Everybody starts getting knocked over. It's possible. It's not inevitable. Like I said, a lot of this is hedging. A lot of this is looked at a lot more closely today than it used to be, but not everywhere in the world. So it's definitely a big cave full of dynamite and TNT, and it's the fuses aren't lit. But if a fuse does get lit, then we could be in for some trouble here. All right. Are commodities at a peak? Abdul asks, and thank you for the gift there. I don't think commodities are at a peak. Obviously, they've had a fantastic ride here, but as we transition into this time period of less globalization, more fractured supply chains, and countries getting more nationalistic, less involvement. There's a big shift towards where we've had a long time where real assets, commodities, real stuff has been undervalued, and things that have the theoretical or the hypothetical chance of making a lot of money in the future, given the ultra financialization of the entire economy. We've had a lot of capital shift that way. And so, yes, commodities have done well recently, but it does not seem like it has gotten bubbly at all. Maybe short term, but it doesn't seem like it has gotten to the place where it's like, hey, there's a lot of money piling in here. What you tend to see when you're at the top of a cycle like that is commodity companies just burning through money. They're raising money left and right. It's super easy to get their hands on new money. They're burning through it. They're not profitable. They're wasting their money. When you start to see things like that, then you're like, okay, this is toppy here. And that's what we saw in tech a year ago, 2 years ago. We saw a ton of money rushing in. We saw SPACs and IPOs, and we saw all this money coming in. Unprofitable companies that were wasting their money, having zero revenue, valuations sky high. We're not seeing anything like that in commodities right now, in miners, anything like that. So could we be a little bit frothy short term? Sure. Are we peak? No, I think we're in a long-term bull market for commodities. All right, what else is going on right now? The two-year treasury absolutely going crazy right now. I apologize, I can't pull this up on the screen. Next time I do a live stream, I'll make sure I have the screen sharing ability turned on. But the 2 years up over 3% right now. To give you context on that, that is above the high in 2018. So if you remember what was happening in 2018, the Federal Reserve was raising rates. The Federal Reserve was saying, hey, we're selling assets or letting assets roll off of our balance sheet, and we're raising rates because we want to tighten here because we've been loose for like a decade now, and we want to start pulling that back. And they had room to do that because the economy had just gotten kind of a cash injection or a lack of cash withdrawals from the Tax Cuts and Jobs Act. And so there was room to suck some of that cash out for the Federal Reserve to say, hey, we're maintaining our credibility here by finally tightening like we said we would. Now, obviously, the administration at the time was very unhappy about that and saying, hey, even though I campaigned on the Federal Reserve causing a bubble, now that I'm in, I want you to keep on causing the bubble and saying we need to drop rates, we need to stop raising rates. And eventually the market couldn't handle it at the end of 2018, and Powell reversed course. They stopped raising interest rates at that point, and that's when the market bottomed. The 2 year right now is at 3 or over 3%. It is currently higher than it was in November of 2018, which is when the 2 year peaked. And so that's some context for you on how crazy rates have gotten. And it really speaks as to, how long can this go? Because last time rates were this high, the 2-year, they couldn't keep on going, and they reversed course. Now I think they've got a little bit more public push to tighten, because people are saying, hey, we need you to fight inflation because I hate how much I'm paying at the pump. I hate how much I'm paying at the grocery store. And so people are feeling that pain. And so they're more okay with feeling the pain in stocks drop. Whereas back in 2018, that was like the main thing, because there wasn't as much inflation back then as there is now. So that's the big question, because rates are getting high. The last time they were as high as they are right now was July of 2008, I believe. June of 2008, they peaked there. And then they dropped right back down. And then before that, it was 2007 where they were up there for a while. So that's a question: how long can they go? And it is only a matter of time. But the rate curve, the yield curve, is flattening, obviously, because we've got the short-term rates spiking a lot more than the long-term rates. So the 2 years at 3, the 10 years at 3.1, 20, 3.4, and then 30 at 3.2. So that end of the curve is already inverted. And what that's speaking to is the expectations that the Fed can't keep this up for too much longer, because when short-term interest rates are higher than long-term interest rates, that's inverted. That yield curve is inverted. And that speaks to the expectation that we know or expect monetary policy will flip and rates will get pushed back down in the future. And the further out into the future you go, the more that likelihood is priced in, basically pricing in a recession or depression or crash so severe that they're going to have to reverse course and lower rates. And so it's a matter of time to see how and when that happens. All right, seeing some comments and conversation about Bitcoin, cryptocurrencies, and central bank digital currencies. So I'll give a quick thoughts on that right now. Number one, I think right now Bitcoin is a fantastic asymmetric bet. At the very least, it doesn't really concern me what the price is. The only thing that matters is, will people want to use more of Bitcoin in the future than they use today? And if the answer to that is maybe, then it's a buy. Not for 100% of your portfolio, as some people would say, but it's an asymmetric bet, just like anything is. And so some things are asymmetrical bets to the downside. So think like a savings account or a CD, certificate of deposit at the bank. Those are asymmetric bets to the downside, because the best thing possible that can happen is you lose 8% of it to inflation, right? So your best case scenario on a CD is your purchasing power goes down by 8%. That's not a good upside. And then worst case scenario, something crazy happens in the economy, something crazy happens to the bank, something crazy happens, it gets frozen, you get locked out, bank goes under, FDIC goes under, whatever it is, and you're left with zero. So best case scenario, you lose 8%. Worst case scenario, you lose 100%. That's an asymmetric bet to the downside, not the upside. When you look at something like Bitcoin, asymmetric bet, best case scenario, it becomes used as base money, the global reserve currency everywhere. Obviously, it can't be used for every single transaction. That's where layer 2 things come in, like the Lightning Network. And so that happens. It has to be worth at least $1 million in today's dollars. And so it's an asymmetric bet to the upside. How likely is that? Nobody can say. But if the chance is more than 1%, if the chance is over 0%, then it's worth putting some money in, because the best that can happen is it goes up a lot. The worst that can happen is you lose everything that you put in. That's an asymmetric bet to the upside. I disagree with that argument, though, for any other cryptocurrency, simply because for a lot of reasons I don't need to really and we don't need to really get into right now, but essentially because most of them are doing the same job as each other. Most of them are doing the same job as Bitcoin. Most of them are doing the same job as layer 2 solutions. And if they're not doing any of that, they're trying to shoehorn their way into technological applications where it makes the technology less efficient, more costly, slower, doesn't improve or benefit at all. You can have other technological applications do the exact same thing, just way better, way cheaper, way faster. And then, Robin, your question was about CBDCs. Will Americans reject CBDCs when they attempt to roll them out in the US, or will they be too busy watching TikTok to care? Will education be enough? There will definitely be some people that will never touch it, and there will definitely be some people that will be right on board with it. The key to rolling this out, if you're at the Federal Reserve, or if you're a government official, shut this off, stop watching, because I don't want to give you any ideas here. But if I was a tyrant and I was in control and I wanted to roll out a CBDC and I wanted everybody to use this CBDC, the way that I would do it, I would first let some sort of a big crisis happen. I might not cause it, because the paper trail to showing that I caused it, especially on purpose, would be too evident. So I would take a step back, knowing, like, if I was in control right now, knowing that the bust is inevitable after the boom, everything is starting to crash. If I just do nothing, everything goes downhill, right? And so, because that's the recession is a cure. That's what naturally happens, and that's what's supposed to happen. And so I would step back and let the pain set in. Once the pain is enough, once there's mass layoffs, mass bankruptcies, corporations defaulting on their debt, corporations going bankrupt, shutting their doors, everybody's losing their job, nobody can get food, people are going hungry, people are going sick, blackouts because people aren't going to work anymore, so the grids aren't being maintained, something happens, big crises everywhere, riots, chaos, things like that. At that point, when pain is just acute enough, I would say, we've got the solution. First, here's the problem. All of these symptoms that you're seeing right now, all of the lack of access to food, all of the riots, all the asset prices collapsing, all the bankruptcy, is not because of our intervention. It's because of our lack of ability to intervene to the extent that we needed to. We could have saved it, but we didn't have the right power. We could have saved it, but we didn't have the right information. We could have saved it, but the wrong person was in power and used it for their own agenda. So then at that point, I would say the reason why we didn't have the control and the information and the power is because of our old antiquated monetary systems. We've got a dollar that's built on debt, but it's built on debt because it was built on a fractional reserve system. But it's built on a fractional reserve system because it was built on a fractionally reserved gold standard. It was built on that fractionally reserved gold standard because that was our temporary fix for a gold standard 100 years ago. So we've got this momentum from this archaic system that has given us these arbitrary legal limits that if those weren't in place, we would have been able to do things that we needed to do. We would have been able to get you the money that you needed. We would have been able to stop the prices from falling. We would have been able to save the entities that needed to be saved. But because of these arbitrary, archaic systems and loopholes or fences, they stopped us and we couldn't save you. But now we have the solution, a central bank digital currency. We fold the Federal Reserve into the Treasury, so it brings it under government control. That way, it's no longer independent. We can 100% control this, number one. Number two, we roll out a central bank digital currency. This means you bypass the banking system. We no longer want to bail out the banks. We're nationalizing the banking system. We no longer want to make bankers rich off the backs of Americans. We are nationalizing them, making it more accountable to you voters. So we are bringing that all in together, and we are going to say, hey, look, this now has accountability. This now we're not making bankers and CEOs of banks and financial institutions, exploiting Americans. And then we are saying that we're doing that through the central bank digital currency. So instead of having an account at your bank, you're going to have an account at the Federal Reserve, at the federal government, the Treasury, whatever it's called, the Fed wallet, Treasury coin, Treasury dollar, greenback, whatever it's called. With that, here's the first thing that we'll do. We're going to give every individual who signs up for this $2,000 every single month. So you've got a family of 4, you're going to get $8,000 a month. Living wage now with inflation, that's how much Americans need in order to live. Now, because we are trying to make sure that we don't have the same problems that we did 2 years ago, you're not going to be able to use this to get rich. You're not going to be able to use this to buy stocks. You're not going to be able to use this to buy crypto. You're not going to be able to use this to buy pew-pews. You're not going to be able to use this to hoard things. So we are going to maintain some limits and controls on what you can do with this money. You can buy food as long as you're not hoarding it. You can buy gas as long as you're not hoarding it. You can buy all the things that you need, spend it on your rent, as long as you are not passing up the limits that we set. And we're setting these limits for your own good. We're making sure that we're not going to have shortages in things from hoarders. We're going to make sure that we don't have asset bubbles because you decided to spend all of your money on something that you shouldn't have spent your money on 2 years ago. So we're going to implement all these controls. Number one, we're going to take care of you because we're going to give you the money that you need. Number two, we're going to take care of you to make sure that you're not acting out of stupidity and making sure that you only spend this stuff on this money on the stuff that you need. And then we'll be able to dynamically control it in time. So if we do see an area of the economy that is starting to go down that needs support, we're going to say, hey, everybody, you can go spend we'll give you an extra $500 to go spend money on clothes this month, an extra $500 to go spend money on some area of the economy that needs help. Maybe it's a certain demographics of small business owners, given their certain identities, whether it's race or gender or sexual preference or something like that. If you've got a business registered with the government and you've said, hey, I'm this type of business, we're going to give everybody some money that can only be spent at your types of businesses to support that because they're necessary for our economy. So you're going to see this rolled out, in my opinion, in a way that gives everybody an instant buy-in because, number one, they're experiencing all that pain from the crash. Then number two, they're getting a lifeboat because they're saying, hey, it's either I go hungry or I get this wallet. And once that happens, everybody starts getting sucked into this system. Now, you will have some people who have prepared, some people who have escaped the system, some people who have gotten some of their wealth outside of the system beforehand that will never sign up for this. Barter will pop up, black markets, parallel markets, especially if these things become law and not just suggestions. You're going to see some people opt out. Now, the big question is how many people will opt in. The big question is how much pain will they let happen before they try and bail the system out? Because if they don't let enough pain happen, the adoption for the central bank digital currency won't be enough to make it work. And so if I was in control and I wanted the most adoption possible into a new system like that, that is the way that I would do that. And hopefully it doesn't happen, because 9 times out of 10, the negative things that happen from the top down are a result of incompetence and not a result of malevolence, because most of the time people in that position are actually incompetent, and so the worst case scenario would be competence mixed with malevolence. That's the one we don't want to see. Thank you, Kickjack and Crossfade. I'm trying to answer all the super chats as long as I see them. So I apologize if I do miss anything. I'm trying to pause on the chat there as soon as I see one and answer one. We've got about 5 more minutes left before we sign off here. Let me just make sure there's Sebastian, thank you as well. Looking to Monero, it has privacy aspects. Yeah, there's always going to be a trade-off between privacy, between security, between speed, between efficiency. And from everything I've been able to tell, given the network effects and the size of the Bitcoin network, any of the other trade-offs where you try and have, where you try and give the proper trade-offs to deliver a solution other than Bitcoin, because Bitcoin's pseudonymous, it's not anonymous. You tend to have some major flaws, many times leading towards centralization that provides a surface area of attack that's so much larger that if the government decided, they could shut it down. We'll see. All right, let's see here. I'm going to contrarian 08. The more communist in the West becomes with these sort of policies, the more supply shortages, wealth destruction, civil unrest there will be as a first world country becomes a third world country. That's unfortunately the course of history. Rome is not a great empire anymore. Greece is not a great empire anymore. Egypt is not a great empire anymore. There have been countless empires that have risen and fallen. Very few have ever come back. And so that is unfortunately the natural course. This is something Joseph Schumpeter talked about in Socialism, Capitalism, and Democracy. Capitalism, Socialism, and Democracy. He talked about how basically freedom births great wealth, and then that great wealth funds the socialist and communist policies that end up destroying that wealth. And it's kind of like the life cycle of great powers and empires. So unfortunately, that is true. China is one of the countries that has come back multiple times in terms of how strong it is relative to other empires around the world. That is one of them that has repeatedly throughout history. Part of that, though, is that they're one of the oldest continuous nations and people groups on Earth. And so that is definitely part of it. All right, 2 more minutes here before I sign off. Looking for some other questions here. I'm seeing a lot of questions about when to buy, what to buy, that sort of thing. Right now, I still think that we have the most. We have a lot of pain until we see a reversal in any sort of policy from the Federal Reserve. So you're not ever going to be able to time the bottom in anything. But this is why gold is starting to go up, because it's starting to price in the higher likelihood that the Federal Reserve is going to have to reverse course and ease again. And so if we see the reverse repo facility, the rate that they're paying on there, drop below the Fed funds rate, that's a major buying signal. If we see QE start up again, even if it's just for new treasuries from the government, even if it's just for the new issuance, if we see interest rates stop getting hiked, if we see any sort of a policy reversal where they just pull back on how hard they're tightening, I think that is a major sign that the bottom is close, because that means they're seeing something pop up that is alarming to them. And by the time they see something that's alarming to them, there's other things that have started to build up. Remember, they're very backwards looking and they're slow to react unless there's a crisis happening. So these things build up in real time and they don't see them until way after. So by the time they see them, they're a lot worse. And by the time they start to reverse course a little bit, the seeds have been planted for something to come in that they're going to have to go full force in easing on. The wild card is if they don't reverse course. But I'll be making a video about that soon. What if the Federal Reserve is going to allow deflation, depression, full on, just full stop? We're going to let everything crash, because technically that's a possibility. I don't think it'll happen, but it's worth exploring the ramifications of that, so that just because it's possible, you can prepare just in case. Thank you guys so much for hanging out with me for the last hour. I apologize for the technical difficulties, and next time it will be better. Thank you for all the gifts, everybody. Hope I answered as many questions hope I answered enough questions for you guys, and we'll see you next time.